Good morning, Distinctive Properties and Commercial Prime Properties. Welcome to the Friday before the weekend. You saw in probably my newsletter from Sunday that today is that dreadful beginning of tax day. So here we sit. We've got a wonderful speaker today, a wonderful Q&A that's going to come up. Jim Woolley, right now, Jim, you are cued on the screen so everyone can see you. Jim is the founder and are you the CEO, is that right? Founder and CEO of Mammoth Financial?
That's correct.
And you're a CFP,
correct?
Right? Which is, for those that aren't, into the financial industry, that is quite the designation to get if you are in the industry. So congratulations on that. You've been in the business for how long?
Last month, it was 23 years. Started in 1999.
Oh my goodness. So we do have a veteran on the call. Look, one of the things that we talk about, Jim, with all of our agents is being that trusted advisor, right, to their clients. The more they know about practical applications of the transaction, the more they know about options for their clients, the better it is for them, right? And the better it is for their clients. I had the privilege of going to your open house a few weeks ago. I was in Twin Falls. And I was talking to Jim, and up came this concept of 1031 exchange, which a lot of our agents know about. And he's had some recent success with some of our clients within Twin Falls. And I don't know if anything beyond that, but specifically with our Coldwell Banker agents, we've got Gary Shook who's going to be coming on in a minute to kind of give you some of that validation of some of his client experiences working with you. Good morning, Gary. Gary's on his way also to Boise to have some lunch with our Boise agents out there. So thanks for doing that, Gary. Appreciate it. Good to see you this morning.
You too.
All right, Jim, I don't want to go too far with it, but really what we're talking about is the Delaware Statutory Trust. It's a 1031 option. I'll let you dive in deep on that kind of stuff, but it's really about tax strategies for investment property owners, tax deferrals, approved by the IRS, all that great stuff. So I'll go ahead and let you take it away and have the floor. And you should be able to screen share. I know you've got some of the slides ready, so it's all you.
Sir. Thank you. I will share here and we'll see how she goes. All right. So can everybody see my screen okay? You're probably seeing, I think actually you're seeing my presenter screen instead of, I will share my other screen. So you're not seeing the boring stuff. All right, looks like we're probably good to go there. So thank you, Ryan, for that introduction. Yes, Mammoth Financial is an independent financial planning and wealth advisory firm located in beautiful Twin Falls, Idaho. And if you're finding yourself going, where is that? Believe me, you're not the only one, but we're in southern Idaho. And as a financial advisor, you probably think most of the stuff that we do is help clients with stocks, bonds, mutual funds, and hitting their financial goals. And that is what we do. But one thing that my firm does that's a little bit different is we can consult on these special real estate transactions. So the presentation I have today is going to give a little bit of an overview of what a 1031 exchange is in case you're not familiar with it. And then if you are familiar with it, or once you've kind of learned a little bit about it, I'm going to show you how, as a financial advisor, I can offer a product, a financial product that qualifies as the replacement property, and how that could benefit you as a real estate professional. You guys are a trusted advisor to your clients, especially those that might have significant real estate holdings and a lot of investment property. And they talk to you and they go, I'm trying to do this, or I'm tired of being a tenant, or I wish I could free up this capital and do something else with it. And as a trusted advisor, the real estate professional can come through and say, hey, have you heard of a 1031 exchange? Oh yeah, I've heard of it, but I don't want another investment property. And you can say, well, hold on, we might have another solution for you. So a 1031 exchange, as Ryan mentioned, is a reference to a section in the IRS code. And now I'm having trouble with my slides advancing. The IRS code that says you can swap like property for like property. So about 100 years ago, Congress said, for somebody that owns real estate, sells that property, whether it's a piece of farm ground, because 100 years ago, it was probably a piece of farm ground, or a factory, or a rental property, or a building. and they don't want to take the cash, they want to reinvest it in something else, we don't think they should pay tax on that. So Congress, in their wisdom 100 years ago, came up with Section 1031 exchange of the IRS code that allows real estate investors to do that. I'm going to try to share my screen again because, like I said, we are having some technical difficulties here. And if we don't end up sharing the screen, I'll just talk about it and it will still be a good time. So as I said, a way as a real estate professional to advise your clients in ways that will allow them to potentially change some things that they are doing. All right, we are having an epic failure here. I apologize, Ryan. We'll get this back up here.
But it's probably because what you majored in at Gonzaga that you're having such technical difficulties. Journalism, journalism, music, and history, right?
Right. So business and technology is a struggle for me, apparently. So let me try one more time here. Again, I sincerely apologize to those of you that are waiting for the best presentation you've ever seen. All right. Okay, we'll go with that. You're seeing the background again, we'll go with that. So again, 1031 exchange is exchanging like property for like property. And as a realtor, you guys live and die by being able to get listings, right? Having your clients come to you and say, I want to sell this house. Well, what if you could potentially unlock listings for a client and come to them with an idea that they necessarily haven't thought of yet and become a hero in that situation? So in a 1031 exchange, right, if we look at the ability to sell a property and defer taxes to a later date, we're not getting out of taxes with a 1031 exchange. We're just deferring the payment of those taxes to another date. And if we look on the screen here, if a client sells $1 million building and they pay tax on it, they're going to be left with less than $1 million. Now, hopefully they've got a great CPA, they can minimize taxes, but they're going to be left with something less than $1 million. With a 1031 exchange, you can reinvest that full $1 million, hopefully into another property, a bigger property, maybe help your client move up in their financial goals and what they're trying to do. So when you're looking at a 1031 exchange, there's a very crucial process that you have to go through, a step-by-step process to make sure it qualifies for this transaction. The first is, of course, you got to sell the property. Whatever property they have that they want to sell, you got to sell it. Escrow opens, right? However long escrow is going to take. Once escrow closes, that's when some magic starts to happen. And the next phase of that is to work with what I call a qualified intermediary. You folks probably refer to as an accommodator. And the accommodator one is they take the money from escrow, they place it in a special kind of holding period while you look for a replacement property. And that accommodator or that qualified intermediary makes sure that the chain of money flow never goes to your client. Because if the money goes to your client, the 1031 is broken at that point and they have to pay tax. So the qualified intermediary is a very, very important step in the process. And they are professional folks who are very familiar with this, and they'll make sure nothing happens to your client and everything is taken care of. Then the last step in the process then is the replacement property for the 1031 exchange is identified, and the money flows from the qualified intermediary to purchase that property. Now, the solution that I have that Ryan alluded to a second ago is a special trust called a Delaware Statutory Trust. And Delaware means that the legal document is domiciled in the state of Delaware, but other than that, Delaware doesn't come into play. That's not important. But it's a special trust that was created to own commercial real estate held for investment purposes, which sounds like a replacement property as per the guidelines of the IRS. So back in 2003, the IRS issued a private letter ruling that said, yeah, we've looked at this Delaware statutory trust thing, and we think it qualifies as the replacement property. So it was created just about 20 years ago for this purpose. It qualifies as a replacement property. It's a multiple investor share ownership. Your client will become a beneficial owner in this trust. Now, the type of real estate that the trust owns, we'll get to that in a second. But the nice thing, I think, is this last piece over here, in that if you've got a client that says, I really like the benefits of owning real estate, I like the income, I like the capital appreciation, but man, I'm tired of managing the property, or man, I'm tired of the 3 T's, tenants, termites, and toilets, right? If they're tired of those things, they might be in an ideal position to benefit from one of these Delaware statutory trusts. And these Delaware statutory trusts generally have three phases. So a professional real estate management company, some like Cantor Fitzgerald, you may have heard of them, some like Inland Private Capital, some like Pasco Real Estate, will form one of these trusts. They'll go out and acquire a property or multiple properties inside of this trust. That's phase one that you see. Phase two is they'll manage it. They have a professional management team, or they'll hire a third-party professional management team to manage that property, whether it's Class A multifamily, whether it's retail, whether it's office buildings, self-storage, they'll manage it. Now, the manager is going to charge fees for that, of course, right? And the trust will pay those fees. Your clients won't. And then at some point in the future, down at the bottom here, the trust is going to liquidate, meaning the trustee of the trust is going to sell the properties. And at that point, your client has a few options. When the trustee liquidates, they can take their cash. They can say, you know what, this was really good. I enjoyed the income that this trust provided, but I'm going to take my cash and I'll pay taxes. They can do another DST. They can do another Delaware statutory trust via 1031 exchange, or, and here's where your ears should be perking up, the third option is maybe they'll bring that money via 1031 exchange back to local real estate. And that's where you, as the real estate professional, can step in and say, hey, I've got some buildings, or I've got some other rental properties that you might be interested in. Let's go take a look and see what those things are. Your clients will get the notice when the trusts are liquidating. So you'll have probably a 45-day, maybe 60-day lead time to help that client maybe find another solution, which could result in another sale for you and another opportunity to come in as the hero for your client. So now you're probably asking, what type of properties are owned by these Delaware statutory trusts, or DSTs? And what you see on the screen there is several different types of properties: hospitality, multifamily, doctor's offices, self-storage, student housing, warehouses. The big ones right now are multifamily, self-storage, and industrial. Things like Amazon. Amazon doesn't like to own their own real estate, so they'll build warehouses and they'll have somebody else management. And I had a DST about 6 months ago, was an Amazon warehouse over on the East Coast. Right now, the two most popular are the multifamily and the self-storage. So you'll have this trust that maybe it owns 5 multifamily properties throughout the United States, maybe in Arizona, Florida, outside of Boston. They're usually in up and coming metropolitan areas, and they'll be really nice. And those multifamily housing, as you know, are very appealing for seniors who don't want to care for lawns anymore and don't want to mow the grass. It's great for young families who maybe can't afford a home right now and are looking for affordable housing, or those professional millennials and Gen Zers who owning a home just isn't important to them, but they want the benefits of being in a city center or a workout facility, a really nice pool, those types of things. And so these properties are very appealing and they're growing. And in fact, one of the best hedges to inflation, we're all dealing with inflation right now. As a real estate owner, what can you do? You can always increase your rents. And that's a great way to hedge against inflation. And these trusts do the same thing. So getting back to the basics of a DST, the timeline that you guys have to be sensitive to, and these are set in stone. As Ryan knows, Gary knows, these dates are set in stone. You sell the property, it's called the relinquished property. You have 45 days to identify a replacement. After you identify that replacement, you've got up to 180 days to close on it. Depending on the type of trust and the real estate, right? If it's local real estate, closing on that property might take a while, 30, 60 days. DSTs typically take 5 to 7 business days. So they're pretty quick. And in fact, I'll tell you a quick story. If you look at the center box there that says 45 days to find a replacement, I had a client who spent last winter in Arizona. She's part of a senior community in Mesa. It's a great place to live. She loves it. She called me, I think it was April 4th last year. And she said, hey, guess what? I sold my dairy. I said, hey, that's great. Congratulations. When did you sell it? She said, February 15th. I said, is that when you listed it for sale? She's like, no, that's when we closed on it. And I kind of said, okay, why are we talking? Well, I want to do one of those 1031 exchanges that you talked about and one of those DSTs we talked about in our last appointment. I said, that's great. Let me see if we can do it. So we basically had 2 days to identify that replacement property. But we were able to do it because the DST, we know what the inventories look like. Nobody's running around late at night looking at properties or on the weekend. Gary's not taking clients out on a Sunday afternoon instead of playing golf to look at properties. They close pretty quickly. And so even in a compressed timeline, or if your client sits there and thinks, I don't know what I want to do. Oh, I want to do this. You still have the opportunity to offer a solution for them. Last but not least, let's talk about boot for a second, because that's always this mystery thing that kind of exists in a 1031 exchange. The definitions of it are clear, but it's not always clear how they're applied and what things that we want to avoid. A boot or boot in a 1031 exchange is some sort of financial gain, whether it's the relief of debt or whether it's the value in another property that a potential 1031 exchanger can get by doing the exchange. And that boot may be taxable, right? And their CPA is going to tell them the sad story of, yep, that was taxable, shouldn't have done that. Well, how can you, as a real estate professional, help clients avoid boot and maybe even give them an opportunity, or give yourself an opportunity to have a couple sales in the process? So let's say in these scenarios you see on the screen there, you got a client that's selling a $2 million building, and he or she finds a replacement that they really like, but the value of that replacement's only 1.8 million or less than that, right? That difference between what they've sold and what they're buying is taxable gain. That's boot. And you're like, well, I don't really want to go out and buy a bigger building, maybe take on debt, get a loan, anything like that. So what do we do? A client's just going to have to pay taxes. Well, you may not know, for those of you who are advanced at this and have done 1031 exchanges before, you might not know that you can do partial exchanges. And in this scenario that you see on the screen here, that's what we're looking at. You help that client with that $1.8 million building to replace part of what they're selling. You can contact our office and we could recommend a DST or two to fill the gap and get that other bit of income or that other bit of money in the process or in the exchange filled with a Delaware statutory trust. You help the client sell a building, heck, you even sold them a second building, and you saved them a bunch of money on taxes by knowing about this concept and this product that's available to your clients. So at this point, Ryan, do we want to pause and see if there's any questions?
Yeah, thank you, Jim. That's such useful information. I mean, there's a lot of things hidden in there that maybe we can discuss real quick. One of them, we've got a question from Robin. It sounds like a REIT. I know it's not, but I'd love to hear your definition why it's not.
So, Robin, I like that because you keyed in on a trust that owns real estate, right? Sounds like a real estate investment trust or a REIT. A REIT has a very specific ownership structure and a very specific way that they have to deal with income and pay taxes. REITs have to distribute about 90% of their income to qualify as a REIT, and their ownership structure has to be a certain way. Also, as we boil down to where your clients are in the food chain, right? How are they evolved in a DST? Well, in a REIT, right, everybody is essentially an owner of the REIT. Now, ownership gives you access to equity, but ownership also makes you responsible for loans or debt. And so if the REIT goes sideways, the property goes down in value, we have another big real estate cycle like we did in 2008, 2009. And a lot of REITs are not traded on a stock exchange, meaning they're illiquid. You're just kind of stuck with it. That can be a precarious situation for a client to be in. Now, a REIT also, you can buy a REIT with cash you've got in your bank account or your brokerage account. Another difference between a Delaware statutory trust and REITs are the only way to buy one of these Delaware statutory trusts is via a 1031 exchange. So you've got extra scrutiny and extra regulation that you have to pay attention to go into this trust. The other part is, yes, these DSTs will have leverage. They'll have loans associated with them, but the benefit for your client who might buy one of these, those are non-recourse loans. The trustee of the trust is responsible for the loan, not the beneficial owners or your client. So if the property goes sideways, yes, all real estate can be sold at a gain or a loss. The trustee of the trust might decide to liquidate the property at a loss, and that loss will flow through to your client as a capital loss, which they can use on their taxes. But the loan, the leverage that's associated with it, will not flow through to your client. It's a non-recourse loan. So that's one major difference. You do need to know that these DSTs, similar to REITs, are illiquid during the life of the trust. So once this trust is in place, once your client has bought in, they're committed for the life of that trust. Now, the standard life of these things, as I tell clients, is about 7 to 10 years. So commit to 7 to 10 years. The average life, what I've actually seen, having worked in this market for about 4 years, having reviewed data on probably 100 or 150 of these with the vendors that I use, the average life is about 5 years. So it's illiquid. Your client cannot get out. They cannot sell their interest to somebody else, but they typically don't last the 7 to 10 years. And when they do liquidate, again, your clients have the option to do another DST, take their cash, come back to local real estate. So I hope that answers your question, Robin.
Maybe one more thing to add is the tax efficiency, if you will, of depreciation. So if you have a property that's fully depreciated and you go into one of these DSTs, you can start that depreciation process back over. Is that right?
Well, the depreciation, that's kind of between the client and their CPA, but the depreciation and the value will be taxed, or excuse me, will be tracked. And so if a client has a $300,000 rental that they've depreciated down to 50,000, right? If they sold that property, 50,000 would be their cost basis, right? So if they do a DST, that 50,000 of cost basis will carry over, right? So they may have sold the property for 300,000. They had a cost basis of 50,000 due to depreciation. So they avoid 250,000 of capital gain, but that 50,000 will track through to the DST and will have to be accounted for on that next sale or that next exchange. That'll track through. Ryan, one of the good news is real estate gets a step up in basis, right? So if I had a rental property and I passed away and sent that to my kids get a step up in basis. That step up in basis does apply to your client's value in a DST. So it has built-in estate planning where you can avoid a little bit of the taxation of that depreciation if you die with it. Now, nobody wants to say, hey, good news, your kids don't pay taxes when you die. Well, that's great, kids don't pay taxes, but I'm still dead. But that step up in basis, even with this complicated financial product, carries through to your client as well. So they can use it as a built-in estate plan as well. The kids will get a step up in basis upon mom and dad's death or upon the transfer of the estate or things like that.
Got it. And there is a minimum amount, and that is it 100,000 as a minimum investment?
Good question, Ryan. And I'll answer that in two ways. The first is in regards to this financial product. It's a very complicated financial product according to the regulators. My business, like the real estate industry, is regulated. We have government agencies like the Securities and Exchange Commission, like the Financial and Insurance Regulatory Authority, FINRA, that watch over what we do and the recommendations we make to clients. And those regulators have said a Delaware statutory trust, not a 1031 exchange, but a Delaware statutory trust product is only appropriate for accredited investors. And that means that your client must have a net worth greater than $1 million, not including their primary residence. So if you've got a client that's got a mutual fund portfolio, they've got a 401k or an IRA, they've got a commercial building, several commercial buildings, things like that, they'll pass that bar pretty easily. But my job as an advisor, and the way the process would work, is if you're talking to a client and they say, hey, I'd like to do a 1031 exchange, they're not finding replacement property locally that you can help them with, you refer them to our office. And that's one of the first things I do. I take them through a series of questions to kind of ensure that they're one of those accredited investors. Now, not all of you on the call today might be an accredited investor. That's okay. I'm not making a recommendation of a Delaware statutory trust to you folks. I'm helping educate you and helping you understand and learn another solution that might be out there for you. But these complicated products, they have those regulations, right? And then Ryan, back to your question, is 100,000 the minimum? That's what all the brochures say, but real estate moves so quickly that my DST vendors that I work with, I've got 4 that I work with on a regular basis, they won't turn your client's money away. So the smallest DST I had last year was 47,000. Fit for the client, fit for the firm, fit for everybody. So if a client is selling a small piece of real estate, or they're doing that kind of multiple exchange, that partial exchange, where you're helping them with another property and they've got some money left over, give our office a call because we can probably help.
Okay, that's great. Thank you. And I've got a question here, and I'll try to frame it in the concept of maybe sort of a case study that you might be able to help us with. We've got someone that has a residential property, right? It's a residential rental investment property. They're going to be selling that property. They contact you, and the first thing that or I would say that one of the benefits of coming from a residential rental property is that you can diversify into other products at that point, right? So you don't have to go like property to like DST property. You can actually, you can have multiple DSTs with that single investment, things like that. Is that correct?
Ryan, that's a great question and a great observation. And what you're seeing me circle on the screen here is you get institutional quality property within a DST. Now, whether that's multifamily, whether that's self-storage. So you're going from maybe a residential rental or maybe 2 or 3 to a much bigger marketplace. And so diversifying, right, as Ryan says, you're spreading out risk. If you're going from you own 1 or 2 properties with 1 or 2 tenants writing you 1 or 2 rent checks to 2 or 3 multifamily properties where there might be 900 doors on the properties and you've got 900 tenants paying the trustee 900 rent checks, that's spreading out the risk quite a bit. So even the fact that you might think, well, the clients might feel like they're stuck in this thing. They got to wait 7 to 10 years is what that financial guy said. I don't know if that'll work. Well, over the course of 7 to 10 years, what are the odds that that multifamily property is going to be completely empty? Probably 0. And if they maintain 85 to 90% occupancy, which most of those properties do all the time, that's a great way to spread out risk. You also might have properties in different geographic locations, right? So yeah, you might have a property on the East Coast, or you might have a property in Florida. And yeah, I know that's hurricane territory, but you've also got properties in Arizona. You've also got properties maybe outside of Seattle or something like that. And in fact, something else you can tell your client, I had a very astute client who's done 4 DST transactions with me. And he said, so one of those DSTs has a multifamily property in Glendale, Arizona, right? Kind of down the street from the Cardinal Stadium. I said, yeah, they do. And he said, if I go visit that property and I go to a Cardinals game, is that a business expense? And I said, well, you need to talk to your CPA, but yeah, that's a business expense. You're going to see your real estate that you own in Arizona. So there's ways to kind of help your clients in other ways too, with diversifying their risk and setting them out. Now, one thing that DSTs do not do, typically they are homogenous, meaning they're not going to own multifamily, self-storage, and retail office space in one DST. They're going to all be multifamily. They're going to all be retail, maybe grocery chain anchored retail shopping centers. They're all going to be self-storage. But as Ryan mentioned a minute ago, your client's got a couple $100,000 and they want to put 100,000 in a multifamily and 100,000 in self-storage. That's fantastic. Now, the last question you're probably asking yourselves is, okay, how does my client make money on this? You said it's just like real estate, has the same benefits of ownership, but so far I'm only hearing about tax deferral. Well, these DSTs pay a monthly dividend. And so that dividend depends on the property. And with interest rates rising and real estate prices rising, right now, those dividend rates are a little bit lower than they have been in the past, but typically they're right now about 3.5% to 4.5%. And so what that means for your client, for every $100,000 investment, they're going to get $3,500 to $4,500 per year. Actually, those dividends are paid out on a monthly basis. So $350, $450 a month in income. That's completely passive income that they do nothing for. I've had realtors say, well, right now my client owns 2 rental properties and their income's about 9%. Well, they're paying property tax, they're paying a property manager, they're dealing with tenants, they're dealing with termites, they're dealing with toilets, right? All that stuff that when you boil it down, their net after all their expenses is probably not far off from the DST. And so I say to clients, again, you don't have to deal with tenants, termites, and toilets. All you have to do is cash the dividend check every month. And by the way, we'll direct deposit it if you want. So that's kind of another way to look at these. How does my client benefit? They avoid taxes. They get regular monthly cash flow. And at some point in the future, they can have the opportunity to defer taxes again, get cash, pay their capital gains. It dovetails into their estate plan as well.
Yeah. In regards to that estate plan, we've got, in a lot of our markets, we have the matriarch and patriarch have passed away, and the asset, the physical real estate asset, has come into the hands of multiple family members. What kind of conversations are you having about that and the benefits of a DST in that sort of scenario?
Absolutely. So there's a few ways to do that. Let's say that the client has just a simple will. And in the will, they've got 3 beneficiaries, right? They're 3 kids. When the time comes, right, sometimes you can have a fight. If mom and dad own 3 rental properties and you got 3 kids, kids each get 1 rental, right? That's pretty easy. Child A sells it, child B and C, they keep theirs. With a DST, if mom and dad have liquidated the real estate holdings, they've done 1031 exchanges, they've gone into DSTs, then when mom and dad die, or when the second one dies, and that's when the transfer of estate happens, right? Nothing happens when mom dies. When dad passes away, that's when the transfer of the estate happens. So let's say mom and dad were in a DST and both have passed away, and that DST hasn't liquidated. It's still within that potential 7 to 10 year period. Well, they name beneficiaries on those DST purchases. So the 3 kids now get an interest in that DST. They get a 1/3 interest in the DST. When the DST liquidates, they still get their step up in basis. Let's say one child decides, hey, I want my cash. Send me my cash. I'll talk to my accountant and we'll pay the capital gains. The second child says, this DST thing is pretty slick. I want to do another 1031 exchange, and I'm going to do a DST. And the last kiddo goes, you know what? I always liked mom and dad's realtor. I'm going to give them a call and see what they recommend, and maybe find a rental property in my area. Because right, these days, maybe those kids don't live in Twin Falls, Idaho with mom and dad. Maybe they live all over the country, and maybe they want to buy a rental property in their neck of the woods. Now, the other thing, that if your client owns rental properties and say that those are owned by an LLC or those are owned by a trust, right? When they sell that rental property, the proceeds are technically still in that entity. So the entity owns the DST interest. And so whatever the entity is, if there's an operating agreement or a partnership agreement that has the kids in there as successors, if the trust owns the real estate or the DST interest and the kids are the beneficiaries of the trust, it follows the estate plan that way. So when we talk to clients potentially about these DSTs, part of the process is we want to make sure their accountant is okay with it. And we want to make sure if they've got an estate planning attorney, that the attorney doesn't have any objections either. And part of the job of our firm is we loop in all those players on the team and make sure we're giving your clients the best advice possible.
That's great. Hey, Gary, you're on the line. I know we're running a little bit of time here. I want to make sure you get a chance. Gary, for those that don't know, within our company is the broker in charge for our offices in Idaho. He's been with the company for quite some time. He's been in real estate for a very long time. But you have recently had some success with your clients by the introduction to Jim and these DSTs. Can you walk us through some of that?
Yeah, what I found is that we had I think we did 2 of them last year, if I remember correctly, but both of them were a situation where the people were like, I don't know what to 1031 this money into if I liquidate this piece of real estate. And so we connected with Jim, gave us an opportunity to sell some real estate, and they'd be able to move out of being a landlord. In fact, and it was super slick. And one of these guys specifically is a retired doctor, and I bet he owns over 160 rentable doors just in the residential, not counting the commercial space. So it was, when that guy of that sophistication come back to me and said, holy crap, this was awesome. It tells me that it's something worth talking about. In fact, I've got a call at 10 o'clock with another commercial owner that he's frustrated with the tenants and whatnot, and we're going to be talking about connecting him with Jim as well. So Jim, I'll be getting a hold of you later today with that. But to me, it's just an opportunity to get more inventory to the market, because that's every time I talk to somebody who has multifamily or whatnot in the past couple of years, their thing is like, well, crap, what do I exchange into? If I liquidate this and I don't have a place to go with it, I'm going to be hit with the capital gains. And so my 2 cents is I'm excited to put in some.
No, it looks like he went back on mute there real quick. Love the validation of that. You know, as we look at talking with our clients, some of the conversations that I've heard recently from our agents is, you know, we've got these properties, we've got these folks that have multiple properties, and they don't want to sell it because we're at the height of the market, right? Why am I going to go exchange property at the height of the market? Well, this could be a potential discussion with them for our agents to say, hey, look, yes, we're at the height of, you know, if you believe that we're at the height of the market, there's a lot of indicators that may suggest that. Here's an opportunity for us to, you know, use the value, right, in a tax efficiency real estate exchange in a 1031 to give us a little hold period, right? So we've maintained the value. There's all kinds of benefits from depreciation to step up base, all these things that are involved in the DST. Just like it was an asset, you're more diversified, potentially in multiple real estate classes, but we get to wait 5 or 6 years. Right, with an asset-backed, I guess security, I guess maybe the best way to put it, Jim. But to have those conversations with your clients and say, yeah, if we are at the height of the market, it's still not a bad time to potentially think about this. What if I set up an introductory call with someone like Jim, consultation? I'm sure, is that okay if your office receives those sort of things from our agents and our agents' clients?
Great question, Ryan. What I think the best process to take is, you as the real estate professional, you don't have to know the ins and outs of the DST. You don't have to know all the details. That range that I gave you for income of 3.5% to 4.5%, you don't even have to know that. You can say, you know what, this sounds like this might be an option for you. There's a special financial product called a Delaware Statutory Trust, or if you've forgotten the name of it, that's fine. You don't want to say California Statutory Trust because that's might scare them away. But you can say, hey, there might be a solution for you. There's a firm that specializes in helping clients with this sort of thing. What I'm going to do is I'm going to call them on your behalf. And I really like the realtor to call me first to kind of give me a heads up. So when Mr. and Mrs. Jones call, I have an idea who they are. Because what I don't want to do is Mr. and Mrs. Jones call me and say, I need to know about a 1031 exchange with some kind of trust thing. And I don't know that it came from Gary Shook. And I don't want to misstep or misspeak or step on Gary's toes. So typically what Gary does is he'll call me and say, hey, I've got Mr. and Mrs. Jones. They want to talk about a DST. He tells me a little bit about the property they're selling. I can say, hey, Gary, you know that this is for accredited investor only. And he says, oh, yeah, they own 10 rentals and a business. If they own 10 rentals in a business, they're probably an accredited investor. So he can give me a little bit of that background. And he says, he can either say, here's their cell phone number. I told them you're going to call, or I gave them your office number. Either one of those is fine. Now, the next step, that first phone call, I'll ask questions, but I don't want to get too intrusive because they don't know me, right? And I don't want them to think that you have referred them to some high pressure salesman. So I ask a few questions. I try to understand who they are and what they're trying to do. Then I'll typically book an appointment in our office, but I'm also licensed in 30 states. I have clients all over the country, and potentially I can do DST business in all 50 states. So no matter where you're located, where the clients are located, we can have a phone call or a Zoom meeting. And I promise I'll have my technology squared away on the next one. And we can talk about it. And that conversation doesn't cost your client anything. I don't send them a bill. I don't send the realtor a bill. I do send pretty nice referral gifts when they close, as Gary knows and a couple of his agents know. But it doesn't cost your client anything to have a conversation. And the last part of the equation is you're wondering, what's in it for me, right? What's my part of the deal? Well, the DST vendor will pay me a commission based on the investment your client makes. It doesn't come out of escrow. It doesn't come out of their proceeds. The DST vendor pays me a commission, so your client doesn't. So really, talking to the client, you and I, as the realtor, the real estate professional in our office as the financial advisor, can provide a great service to the client that saves them taxes, saves them headache, and they're not writing me a check. And then potentially, as Gary mentioned, real estate moves in cycles. Right? Everything moves in cycles, market cycles, real estate cycles. And Gary and I had this conversation 2 years ago that said, what if people go into a DST, kind of shelter their money and grow it in a commercial property for 5 years, 7 years, and we have another real estate cycle. I mean, I hope not like 2008, 2009 again, but we might have a cooling of the market, and maybe the DST liquidates at that time. And now the client can bring that money back to local real estate and invest with you and buy a property and get a heck of a deal. And you've just had another listing and made another sale. So lots of possibilities. It's a complicated product, but the process we go through makes sure that it's indeed good for the client, because the last thing I want to do is have this come back to you as a realtor and think, gosh, I recommended something for a client, it ended up not being a good deal for them. I hope I don't lose their business in the future, because that's what we want to do. All boats rise, clients benefit, your firm benefits, and our firm does some good business as well.
Awesome. Real quick, we had a question on fees. Those fees, you kind of touched on that a little bit. They're already, if you will, baked into that dividend, right? So whatever that fine dividend is, there's no additional things on top of that. You're not paying. Well, I guess, are there any other points or anything like that in addition to that? No. Okay.
No points, no closing fees, no cost to the client. And in fact, when your client sits down with their current real estate holding and they sit down with their CPA, right, they have the ability to deduct expenses off of the income that the real estate produces, right? So it can reduce the taxes they might have to pay on that income. Your client will get a 1099. This is not an LLC. It's not a partnership. They don't get a K1, which K1s are a pain in the neck. This is a simple 1099, but like real estate, that 1099 will list the client's income, and it will list the proportionate expenses that are attributable to them and their ownership, and it will reduce their potential taxable income. So the income is tax favored too. So no fees to the client, no subscription fees, no costs. The DST pays me a commission, and the client can get tax favored income as well as deferring capital gains tax for a period of time.
Wonderful. Wonderful. Well, thank you so much, Jim. You are such a professional in this realm. What we're going to do is, with this being a Focus Friday, we do this once a week. On Sunday, we release out a letter, email out to all of our agents. We'll include your contact information in there, and just so people can get a hold of you instead of us putting it in the chat right away. And you know how that goes. Sometimes people don't copy and paste it. So we'll go ahead and do that for our agents. Hey, look, this is Easter weekend. Right? We've got a lot of people that are traveling. I want everyone to be safe out there. Everyone enjoy their time with their families, their friends, or whatever they might be doing. And these conversations might come up with this DST over the weekends, because it really is an estate planning opportunity for your clients and for your family and friends. Jim, I thank you. Gary, thanks for coming on. I know you're traveling. Thanks for heading out to Boise to meet our agents. If there's anything I can do for anybody, please reach out to me. My cell phone's always on my email. And for the rest of this day and through the weekend, be distinctive. Thank you, everybody.